Lender's mortgage insurance, what is it, how to use it, and when to use it. Nathan Birch here from B.Invested.com.au, and today I want to answer that question and go into detail about the pros and cons of it and what the best outcome is and when you should use it and when you shouldn't. So, Lender's mortgage insurance, what is it? Lender's mortgage insurance, when you go to a bank and you go to get a loan, the bank will only lend you up to 80% of the value. Over that, there's a higher risk because there's not enough skin on the table for the bank if they have to foreclose on the property. And if they do have to go up, there's a premium that's involved called lender's mortgage insurance, where you pay a premium for the privilege of having a lesser deposit. It could be a 5%, 10%, 15%, or anywhere in between. It could be a 92% lend and you could be paying an 8% deposit. It's available out there. Is it good? I used it a lot in the early days, back pre-GFC when I first started. And would I change what I've done? No, I wouldn't change it today. But if I was buying in today's market, would I do it differently? Yes. What are the pros of it? If you've got a small deposit and it's hard for you to save up, to get your foot in the door of property, it is better to be able to utilise that and to borrow using lender's mortgage insurance, because having one property going up in value or no property while you're trying to save, you save 20 grand, the property goes up by 20 grand, it's probably better just getting in the market by paying the lender's mortgage insurance premium to get into the deal. However, if you're going to be aggressive and you've got the ability to, whether it's from equity or from savings ability, to get a large deposit to buy a property with a 20% deposit, I would steer away from it, just for the simple fact that when you buy properties under mortgage insurance, the banks deem you as a higher risk, and it is harder to borrow larger amounts of money. So what I mean by larger amounts of money, you want to buy a property portfolio of 10 properties at, say, an average price of $200,000, $250,000, $300,000 purchase price. The banks will look at you and go, well, you have to put down a small deposit. You've done it for the last 5 deals, you're a bit too risky, we're going to cap you at the 5 properties or at 3 properties or at 2 properties. It just depends on the bank, the lender, the credit manager at the back end of the bank, your broker, how it all gels together. Lender's mortgage insurance can be a good leveraging tool. However, if you can avoid it, it's better to avoid it. Not for the cost, like if it paying the lender's mortgage insurance fee, it can be anywhere from $1,000, $2,000, $5,000, $10,000. I've seen people, depending on the purchase price, depending on the bank, depending on the insurer, all that sort of stuff, varies that fee. Paying the fee for it is fine. Like, I've got no issue in paying that for the service and the getting it, but it's the longevity of building a property portfolio and having 5, 10, 15, 20, 50 properties. So if you're just going to go out and buy a few properties, 2, 3, 4, 5, and it's harder for you to save up, it can be a very, very good deal, especially if some banks do allow you to actually package the lender's mortgage insurance into your loan. So, for example, when I first started buying properties, I think I used a couple of them with Commonwealth Bank, CBA, and I put down 5% deposits. That was like the 5% deposit. They gave me a loan for 97% because the lender's mortgage insurance was about 2% variance for lender's mortgage insurance on the property. So I didn't have to actually fork out with that money either to pay the mortgage insurance. It actually got covered by the loan. So from that perspective, what's best, what's not best? If you have a lower savings ability, lower chance of being able to buy properties, to get yourself the foot in the market, use lender's mortgage insurance as a worst case scenario. If you're going to build a property portfolio over, say, 5 properties at average price of $200,000 to $300,000, I would advise probably not to use mortgage insurance because it gets harder and harder to borrow and service with the banks. As for if you've got the ability to buy a few properties without using mortgage insurance, it's easier to actually revalue properties, refinance properties. That's just from personal experience. Personally, that's what I've seen in the marketplace, and it's important that whoever you go to use and whatever strategy you try to use with it, that you actually go and speak to a specialised bank manager or a property investment broker which will actually be able to help you out with the right, correct professional guidance from that front. So I hope that has answered a few questions and myths upon lenders mortgage insurance, and thanks very much for watching.